Last night, President Trump sang the praises of America and, of course, the new golden era. My first guess, I want to say, is pointing out also that foreigners are buying and not selling U.S. securities. I think that might dovetail what President Trump was talking about. Yardeni research president at Yardeni is with us now. Ed, I do suspect, though, that buying is a de facto sign that foreigners still have a lot of faith in our economy, our future, and the stability of America.
I think that's absolutely the case. There's been this widespread view that we are de-dollarizing and that the foreigners are selling our securities, but the actual monthly data shows that they actually bought last year a record $700 billion of U.S. equities and about 1.4, let's do that again, 700 billion in equities and then 1.4 trillion in fixed income securities. So they're definitely still finding attractive investments here.
Yeah. Back of the envelope, that's over $2 trillion. That's a stamp of approval in anyone's book.
Absolutely.
And by the way, we have a breakout in the rest of the world, equity markets. In some cases, like South Korea, I think it's warranted. In some cases, maybe not, but it's okay. It doesn't necessarily mean the end of American exceptionalism. And that's what I had a problem with the Wall Street's narrative last year. Let's talk about things getting even better. You've been talking a while now about tax refunds. We're going to flash on the screen a chart that suggests those checks are starting to come out. So I want to know what you expect, the difference that this will make for the economy and for the market.
Well, there's some estimates out there that the average refund will be about $1,000 higher than last year. I think last year it averaged $3,000, and this year it could average $4,000. That's real money, and it certainly is going to add up in a big way. So I think that will be an important fiscal stimulus for the economy. And meanwhile, we still have a lot of monetary stimulus that operates with a lag on the economy. And the Fed lowered interest rates by the federal funds rate by 175 basis points since September of 2024. And that stimulus is still likely to impact the economy this year. So I think economic growth is going to be quite strong this year.
And, you've talked positively about the wealth effect. In fact, you talk about it all the time. I saw a recent interview you gave. You mentioned it again. Morgan Stanley was out yesterday warning, though, of a scenario. Let's just say that there's a typical midterm election pullback and the consequences that could have as far as, let's call it a negative wealth effect consequence for growth and how that might impact the stock market. How concerned are you about something like that?
Well, a pullback, even a correction of 10%, even 10 to 20% is no big deal to investors who've been investing in the market for a long, long time. They've got huge capital gains that have accumulated, especially the retiring baby boomers. The baby boomers are the richest retiring generation ever. And what they've been seeing so far is that even as they're spending money, their retirement nest eggs just aren't going to go down because the stock market keeps going up. So yeah, I mean, you could always come up with a bearish scenario by painting a bearish scenario. Stock market goes down, consumers retrench, that causes a recession, that causes the stock market to go down. But I don't know. I'm getting a little bit of recession talk fatigue. I don't know about you, Charles, but there's been that kind of talk since the beginning of the decade. I've been calling it the roaring 2020s. And as a contrarian, I love the negativity that's still very much out there.
I'm in the same boat as you. I love hearing it, although I do worry about the how it impacts certain people who hear it and make the wrong investing decisions. Yeah. You recently also spoke about animal spirits, and maybe we're seeing that inflection in consumer confidence yesterday, really, especially with independent voters. I thought that was pretty interesting. By the same token, we've seen investor confidence pull back a little bit. Are you okay with investor confidence rebounding and let's say Main Street confidence rebounding at the same time? Is that what we're looking for?
Well, there's two measures of the bull-bear ratio that I track, and one of them has been showing that bearishness has increased somewhat, but the other one that I think is actually more useful is the investor's intelligence. That's still up over 3.5, over a ratio of 3.5, close to 4. And so I think there's still quite a bit of optimism out there. I think Bank of America has a similar kind of fear-greed index, and that's still pretty high on the greed side. So I think one of the reasons the market is stalling here is because there are actually too many bulls, and a few more days or weeks of action like this, and maybe we'll have less bullishness. So that, from a contrarian perspective, that'll set us up to move higher. But the market's been holding up remarkably well, as you know.
It has. It really has. It's amazing. And then with some of these big names that be getting hit, people rotating into other areas and not on the sidelines, to me, that's like the ultimate buy signal. I do want to ask you about Kevin Warsh. He's out talking about the AI productivity boom. Interesting. I think there was a report from a major firm yesterday that said that AI really hasn't impacted the economy yet. He's saying it hasn't impacted productivity, but he anticipates that it will. And many think that's going to be one of the things that allows the Warsh Fed to cut rates this year. What do you think?
Well, I think that if the economy is booming, led by productivity, there's no reason to lower interest rates. And Warsh would say, yeah, but if productivity brings inflation down to 2% or less, why not lower interest rates? And the answer is financial stability. Lowering interest rates is going to increase the likelihood of a melt-up scenario in financial assets and real assets, and that could create a problem down the road. So, why mess with success? If the economy is doing well, if inflation is moderating, isn't that the sign that we're at nirvana, that this interest rates are exactly where they should be?
All right, so I got less than a minute to go. Let's pick up on near nirvana. I think the one area that's sort of hard to understand right now are financials. They're pretty good bounce right now, but it's the worst sector of the year. It came in with everyone with pom-pom saying it's going to be perfect for them. All conditions are go. Should we be concerned that financials aren't living up to the expectations, at least not yet?
Well, Charles, I think they've been hit with what some of us are calling AI derangement syndrome. That's pretty obviously been hitting software and cybersecurity and some other areas of technology, but it's also had an impact on the financials. The fear is that all this AI technology is going to put financial companies out of business, and that's ridiculous.
Yeah, we've seen that movie before, haven't we, Ed? Always
Absolutely.
a pleasure to talk to you, my friend. Thank you very much.